Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Craig Hemke of TF Metals Report, located at tfmetalsreport.com. And I got to tell you, a lot of excitement is coming back into the gold, silver, and the mining sector. If you're going to be trading these markets, you need to be checking out TF Metals Report every single day. Or if you're just a stacker and you're looking to add some physical to that stack, Craig is also really good at saying, hey, here's a good dip buying opportunity. So you still need to be checking out TF Metals Report every day because it is one of the best values on a monthly basis all around on the internet. Craig, I'd like to thank you for joining us again on Silver Doctors.
Oh, thank you very much. You guys have been friends for a long time, man. I think we all kind of got started about the same time back in 10 or 11. And I love Silver Doctors. I love SD Bullion. You guys do a great job. So it's always fun to be on your site.
It is, and it's getting really exciting right now, Craig. As a matter of fact, I was zooming out really far on my charts today, and I was looking at gold, back in 2011, and I was saying, you know what? 1800 looks like it's going to be some pretty tough resistance when we're talking about, latter half of 2011, hit up on 1800 a few different times in 2012. So what are you looking at in gold right now? Is it going to be hard to bust through 1800? And what happens after we do bust through that level, Craig?
Yeah, I would suspect it will be. I probably to answer that question, I got to go back in time a little bit in that as 2019 began, we had seen the 10-year treasury get all the way up to 3.25%. And the Fed had reduced their balance sheet by about $700 billion over about a 5-year period from 14 through 18. And that's when the stock market first crashed. And it became obvious that they weren't going to be able to keep doing that. And so I wrote a report in early 19 that said, okay, this is going to be a year gold breaks out because interest rates are going to start coming back down and the Fed's going to have to reverse policy. That wasn't a real popular opinion back then because gold had been, below 1350 for 6 years. And then lo and behold, it did break out. It ended up the year right exactly where I had thought it would get to, which was some pretty significant resistance on the chart around 1480 to 1520. And we got up there in August, pulled back, and then that's where we finished the year. So when I wrote my forecast for this year, it was kind of, a continuation, more of the same. Had no idea this virus stuff would, put everything into orbit. But could still see, though, a move through 1550 and then 1650. And then the ultimate gold is exactly what you said. All those pokes after gold came down in 2011, through 2011 and 2012, there were multiple pokes up toward 1800 that failed. And so I thought, well, that's going to be pretty stout resistance. So our goal for this year was just to get to 1750 to 1800. And we got there in April. So, it's not surprising that we're kind of going sideways here for a while. But we will ultimately go through. I don't have any doubt about it, especially with everything that's happened with COVID. And at this point, right now, as you and I speak, Paul, it's mainly gold is kind of fighting. I mean, it's still getting pulled upward because all these people recognize you got to have gold exposure, gold in your asset allocation. I mean, with the way the central banks are monetizing everything. But then it's kind of fighting a fight against positive real interest rates at present, in that even with a 10-year treasury note at just 70 basis points, if we're fighting kind of in a deflationary environment, at least initially here in this crisis, you're still getting a positive inflation-adjusted return if inflation is negative. Well, what's ultimately going to happen is the Fed they may already be capping yields. They may already be capping rates. And then inflation does pick back up with all this massive money printing surge of the M2 money supply and everything else. Then you'll get negative real interest rates again. You may get negative nominal rates even on top of it. You put all those logs on the fire and 1800 is not going to be resistance anymore. But for the time being, it certainly is.
Mm-hmm. Very interesting. And yes, I find that interesting how you bring that up because, one of the things I've noticed with your work is that you like to put out the general forecast at the beginning of the year. And then you come back and you look at that forecast a couple times a year. So, I think one year, I can't remember if it was 18 or 19, the theme of your year was the generally accepted narrative.
Yeah.
So I guess my question with that is, What has changed this year with your initial outlook in light of the coronavirus? And has it changed your outlook for the metals in general or just specifically? Or can you share how you've tweaked your outlook for 2020 now that we're about halfway through it, Craig?
I haven't at all, actually. And that's all part of the fun, if you will, of putting those out because I think I even wrote in this year's thing that I wrote January the 6th. I said, there's really not much upside in issuing these forecasts because if you're right, all you get is, a few slaps on the back and, well, yeah, anybody could have seen that coming. You're not so smart. And then, when you're wrong, you got food for the trolls forever, right? Oh, you were the idiot that said, da. So there's not a lot of upside in doing it. So I kind of just do it just to put myself on the record. And this year, the three main points were a continuation of what came out of last year, which was lower and lower interest rates. The Fed remember we had the repo crisis that began in September and October of last year. There was clearly a liquidity problem. The Fed was already monetizing $60 billion a month in T-bills, all this stuff that was going on before COVID. And again, now has just been, ramped up to light speed ever since. But my initial forecast and the three main pillars haven't changed. And that was gold going to 1750 to 1800, which was like another 20 some odd % gain, which would, be a very good year. And that's already where we are. Silver, I thought, would go to 20 to 22. Now, I still think that's going to happen. Whether it can go beyond there this year, I don't know. It's a function of how quickly that inflation or those inflation expectations at least begin to kick in. But then the other part of it was, okay, those are pretty good gains. Where there's really going to be action, and what I quoted, my quote was outsized gains were going to be in the mining shares. Because historically, in relation to the gold price, mining shares were tremendously undervalued. And we'd already had this, gold was banging up against its resistance from levels of 2013, but yet the GDX and the HUI and the GDXJ weren't anywhere near those levels yet. So you felt like they had to catch up, which would make it kind of these outsized gains. And that's been playing out as well. And I'm not like some big mining share pumper dude, man. I swore those damn things off. I remember writing a thing in January of 13 saying, man, why does anybody jack around with these things? All they do is go down. Which was kind of the case then for a long time. And then I just kind of by luck and fate stumbled into buying some in late 2015. And that kind of piqued my interest again. And so now I think it's a fun way to kind of leverage money and pick up some extra fiat while we watch all this happen. So anyway, the forecast hasn't changed. And that's a long answer to just simply telling you that it's playing out pretty well so far.
Well, that's good. That's the best kind of forecast. I used to ride a motorcycle, and I used to say any weatherman who makes a forecast better have ridden a motorcycle before, because when they say it's going to be clear and sunny, and then you're in a downpour, all that's horrible, yeah. Craig.
Good point.
Now, Craig, when I'm looking at silver here, I'm looking at a lot of things, and I'm looking at a lot of good things. I'm looking at, 15% move in the price of silver just from last week. I'm looking at also a couple things that I had hope in, but now I'm kind of starting to wonder again. For example, I was looking at open interest coming down a lot, but I was also looking at trading volume, which was really low. So the feeling was like, maybe this is finally showing us that people are moving on from the paper paradigm and the COMEX and the Western, derivative paper pricing structure of the silver market. But now I'm starting to think, oh no, here we go. Now that silver's on the move, they're just starting to naked short crap out of it again, and they're just going to feed it, and we're going to keep going through these wash, rinse, repeat cycles. So, are you a little bit more bullish that we'll see less of the wash, rinse, repeat cycles going forward, or has things changed? Have things not changed? Or did you have anything you wanted to add on to that, Craig?
I don't think things have changed much at all. We saw, what was it, March, when the paper price got washed all the way back to 12, but yet you couldn't find any metal, actual physical metal for less than 25. That didn't seem to have any impact on the paper price. There's just this dichotomy, in what the world recognizes as a price and, these futures derivative trading price versus the actual physical metal. There was a big washout of open interest. It fell, 100,000 contracts just a couple of weeks ago. It was at 6-year lows of total number of contracts on the COMEX, which meant I mean, people just didn't care. People just didn't want it. The banks weren't really trading it, and the speculators were largely out of it. And it was really remarkable at a time when you would think, right? People would get interested and want to own silver exposure and get the leverage of the COMEX and everything that goes with it. It was the exact opposite. We're starting to see some of that come back in, but not very much, just in the last week with this rally. I don't know. Paul, I just don't think people think the COMEX is going to fail someday, and all that kind of jazz. And I don't know, the whole pricing scheme, as you describe it, is going to have to come apart, where all this leverage has been applied, and the rehypothecation and the unallocated accounts and everything else that goes with it. And then that's kind of a global issue. That's between London and New York and points in between. So the COMEX itself, it's hard to watch. It's really curious how the spread has opened between the spot price and the futures price. That's got my interest. But for now, I think it's more the same. I don't, there are guys out there that think, that the banks are going to suddenly stand down and let price rise and, hey, we're all on the same team. And I think that's just like a pipe dream. I think the banks will fight as long as they can.
And now that you mentioned that, I'd like to stay on this for a second, Craig, because, this year we've seen several fascinating things in the markets, really. The epic stock market crash, the equally epic stock market recovery. We've seen the crude oil chaos going to negative 40-something handle. We saw the Fed funds rate pricing in an implied rate of negative for the first time ever. Then we saw the spreads in gold, and we saw the problems with the gold, and we saw them scramble to bring these London good delivery bars or something to that effect to New York, where they could get a fraction of a claim on a gold bar. But my question with that is, and related to the spread in silver, because my understanding, the spread in silver between the spot price and the futures price is widening again. So, could you explain what exactly does that mean? And is it time to actually see some of this kind of weird market mayhem in the silver market itself now, Craig?
Yeah, I mean, it definitely has my attention. As you said, there's so many crazy things going on. One of those crazy things was what happened in both gold and silver, but primarily in gold in late March. And that was, at the initiation of QE to infinity on March the 23rd, which since then, has sent everything skyrocketing. I keep track of it on a weekly basis. I mean, the stock market's up about 25% since QE to infinity, began on March 23rd. Silver's up, 35 or 40%. And the mining shares are going like crazy. I mean, they're the big winners. They're up like 80% in 8 weeks. But on that day, there was suddenly a massive rush for physical gold, and there just wasn't any to immediately deliver. And that caused a major problem for the COMEX, and the COMEX and the CME group had to work with the LBMA to kind of figure out some patchwork workarounds to try to deliver actual metal out of the COMEX. We've seen a huge surge in delivery demand. If you think there's actual deliveries taking place, record amounts in April, record amounts now in May for both gold and silver. A lot of weird things going on. One of those weird things is this huge spread that has opened up between the spot price and the front month futures contracts. There should not be any kind of significant spread at all between the two. And historically, there never has been. And the reason I say there shouldn't be is because it's easily arbitraged. And what I mean by that is if say the spot price is $1,700 and the futures price is suddenly $1,750, well, a party with deep enough pockets should be able to buy at the spot price. Okay, so now you're buying, that should be pushing that up, and then immediately sell a contract at the futures price, pushing that down. And that narrows the gap automatically. And how does that, actually work? Well, okay, you're buying 100 ounces at spot, and then you're selling one COMEX contract to deliver that same 100 ounces essentially 4 weeks from now, 6 weeks from now, whatever. And as long as the gold is there, as long as you're confident that you're going to get your 100 ounces delivered to you, so then therefore you can then deliver it to somebody else 6 weeks from now, it's free money. I mean, it's a riskless trade. You make $50 an ounce. On 100 ounces, you make $5,000. You do it 100 times, you make $500,000. Okay, this should be a riskless trade. That's why there should never be that spread, but yet that spread widened to $70 or $80 on multiple occasions. Now, it has since come down, and people say, well, that was just due to the refineries being closed, and gold was plenty of gold. It's just in the wrong place, and it gets shipped around the planet on airplanes and stuff like this. And that's why that gap opened up. And it has since come down. It's now, between $2 and $10 this week. But what's really curious, Paul, is this same gap is now opened in silver. And silver's, it's like 2 or 3%. It's like 50 cents. Again, the same thing should be happening. There should be arbitrage closing it, and it's not. And that is really curious.
Yeah, and that sounds like it's even bigger on a percentage basis when you take into consideration silver's low price. It kind of reminds me of when they went from, fractions to decimals and that kind of like free arbitrage back in the stock market where this is just one. Or, for example, like the repo market, that also makes no sense because that's also free money. So I guess what I'm understanding is that there's a lot of systemic trust and confidence issues that seem to kind of be coming into play here. Is that kind of what I'm understanding?
Has to be, Paul. And you're wise to point out like the repo thing, because again, what happened last fall should never have happened. But there was this concern, you got to understand who your counterparty is when you put these trades on. And it's only riskless if you have confidence in your counterparty to hold up their side of the deal, right? And that's what the problem was, or at least we assume that's what the problem was in repo. And it's really anytime there's what's perceived to be a riskless trade, that's where the risk comes in. And that's what it has to be what we're seeing is that, again, we were told, these apologizers for the system just say, oh, no, there's plenty of gold. It's just trapped in London and they can't put it on an airplane and fly it to New York, or the refineries are closed. Once they come back online, no problem. Well, then why is this happening in silver now here in May? The mines were closed in Peru. That must be what it is. Well, no, they've all come back online now. And between Mexico and Peru, it maybe cost 50 million ounces or so for 2 months of their combined production. Well, what's 50 million ounces? Shit, the COMEX has allegedly 300 million ounces in it. So there's nothing to stop this arbitrage, to collapse that spread, but it's not happening, which again gets to the end of the day. Someone's not confident in the counterparty. Someone's not sure that they can buy at spot and actually have it delivered in time so that if they sell, a July futures contract, that they have the silver to actually deliver. And so the spread remains and widens. And that's pretty important because, again, getting back to what you talked about earlier about changing the pricing scheme, the pricing scheme is a confidence game too. All these people with their unallocated accounts, and they let banks store their metal for them, or whether it's unallocated, in London or whatever, that's just a confidence game. And if everybody loses confidence in the bank, that gives you a run on the bank. And that's what will ultimately get us back to some type of a more fair pricing scheme. So it's a good sign, at least, that this is happening.
And I'm starting to think there's a lot of confidence games going on right now too. That what you said just makes me think about, like, for example, we've seen actions taken by governments around the world to, for example, ban short selling or something like that. And in fact, President Trump brought that up last week when he was calling out the billionaires and saying they make money to the downside. So, I guess my point there is part of that confidence is that just if it's in the financial system and if it's in the paper system, there's also not just confidence that the gold or silver could be delivered or not, but also that, access to funds could even be restricted or somehow not be available in one way or another, or people could get gated into positions or forced settled into positions, or just other things in addition to just the physical delivery, if I'm understanding that right.
Yeah, those are all excellent points, Paul. And those are absolutely all risks within this kind of, let's call it, massive counterparty risk system. You're right. What about the banks themselves? I mean, do you really want to be horsing around keeping your money, especially in a European bank? Or even some of the U.S. banks. I mean, how many loans are delinquent, right?
Yeah, And Deutsche Bank came out with the negative 0.5% on 100,000 euros. Craig's 100,000 euros is not a lot of euros to have in a bank account. I mean,
Right.
that's one of the reasons why I initially learned about gold and silver, because I just got sick and tired of year after year after year after year of just like, why are we not earning any interest? I mean, I thought that was, people got 5, 6, 7% in a savings account, but no, I mean, and now that it's negative interest, that just makes the case even more bullish for why that bid has been in gold, will stay in gold, and will likely continue in gold.
No doubt about it.
Moving on to the dollar here, Craig. I'd like to get your thoughts on the dollar because I know that you have a few things to say about the dollar. And I'm looking at a couple things. I'm looking at the dollar in a sideways choppy channel, call it the DXY at around 100, except, it looks like we could be breaking down here. But the other thing I'm looking at with the dollar is that, silver is strong despite a dollar that has basically been sideways choppy channel. And gold is still bid despite the dollar not moving one way or another. So if the dollar breaks down even further, there's 2 points I want to make about that. The dollar index. I think that the relatively strong dollar, generally speaking, over the past, call it 6 years, has helped kind of mask inflation a little bit. So this could also return, spark that inflation, that those expectations for inflation. And then the other thing is, silver has been doing really well and gold has been doing really well, despite the dollar just kind of staying their level. So if it turns, that could add a turbocharger onto the price. And even when I'm looking at things like in silver, such as an RSI at 75, well, hey, if the dollar turns down, then we could still see more extreme overbought conditions. If that even am I making sense there at all, Craig?
No, absolutely, you're making sense. You're wise to be considering all of that. And you know what? At the end of the day, the dollar is just either, and you came close to describing it this way, it's either a headwind or a tailwind. It's not. There's the generalists out there that that don't know much about the global gold market, so they think it's just an inverse correlation. But I mean, even just this week on Monday, the dollar was down 3/4 of a point, and gold was down $20. Okay, so that's a gross oversimplification to look at it that way. And so, I mean, that's the first thing people need to realize. It would help, I guess, if the dollar starts plummeting down and breaking down through 95, down toward 90. That would certainly help, probably help silver more than gold, just again, because of that perception. But the challenging part of looking at the dollar and looking at the dollar index is that it's just a basket measurement versus other paper currencies that are anchored to nothing. And so if they all devalue themselves, if the central banks that issue them all devalue at the same rate relative to each other, they don't change. And so I had several people when this QE to infinity was announced, interview me and say, well, doesn't this mean the dollar's going in the tank? And well, look, man, they did over $1 trillion in QE3 in 2012 into 2014, and the dollar rallied. Well, why? Well, because the other central banks were devaluing their fiat even faster. And so, as long as we're going to look at the dollar compared to the other, the euro and the yen and the pound and the rest, then, if they all devalue the same, then they all just kind of move up and down with the tide the same. Maybe a better way to look at it is that, again, gold price is up 18% year to date. Or I'm sorry, it shouldn't be year to date. Since QE infinity began 8 weeks ago, I'd say that the dollar's been devalued against gold by 18% in the last 8 weeks. Maybe that's a better way to look at it, rather than. But again, that's the way a metals enthusiast would look at it. The traditional economists look at it still, the way you've described, and that's just something that perception is going to have to change.
A couple more topics here, Craig. The stock market. I don't know. Is it a brand new bull market? I don't know. I mean, here's my point, Craig. Because I think it ties into the recovery, right? And I don't even think the economy has finished contracting yet. But people are talking about it's going to be a U-shaped recovery. Is it going to be a V-shaped recovery? I think it's going to be an L-shaped recovery. And here's my point.
Yeah.
If it's an L-shaped recovery, and if Main Street is struggling, are they really going to keep ramping the stock market higher? I mean, there's going to be pitches and torches and pitchforks on the streets if that happens, where people are just out of work and struggling and they're trying to get through the maze of government stimulus, and the stock market just keeps on surging and surging and surging. So I guess the question is, do you have an outlook for the stock market, or are you just, munching on popcorn and watching it? And what are your thoughts on the recovery on Main Street?
Well, I think it's beneficial that the stock market is going to keep rallying because it is going to do exactly what you said. People are looking around going, what in the hell? How can there be 30 million people unemployed in the stock market rallying? What it's shining the light on is what we've been discussing at TFMR for years, which is there's no stock market anymore in a traditional sense. It's just a bunch of cash. It floats around. It doesn't matter what the fundamentals are. It doesn't matter what PE ratios are. It doesn't matter what corporate earnings are or, any of that garbage. Because it's garbage. It doesn't matter. Since QE to infinity on March of 23rd, that day, stock market actually went down to begin with. And then that was the low. And the S&P's up something like 25 or 26% ever since. I mean, since that day, I've been saying, why wouldn't the stock market go back to new all-time highs by summertime? Well, there has to be no, there doesn't have to be anything. You're printing trillions of freaking dollars, which lands in the laps of the banks. The banks use unbelievable amounts of leverage to lever those dollars up. And then, what is it, 5 stocks that drive the indices, right? So if you just get Apple and Netflix and Google to go up, the S&P goes up, okay? So, the other 495 in there can do nothing, and the S&P can keep going up. And so I fully suspect new all-time highs in the stock market, and it doesn't mean that the economy is bouncing back. The economy is not going to bounce back for years. I heard, how's this stat? This went, Powell was on 60 Minutes Sunday night, and everybody's focusing on the infinite money supply stuff he was talking about. How about this one? He said, of the people in the U.S. that make $40,000 a year or less. Okay, now that's a lot of people, right? I don't even know. Maybe half of the working population makes $40,000 a year or less. Of that group of people, 40% of them have lost their jobs. That's just unbelievable. And it's not like they're all just going to get hired back in August. And so this is going to, this idea of some V-shaped thing, or people saying, well, yes, that's a very good sign that the economy is going to recover because look at the stock market. It's garbage. Let me give you one more thing, though. The Fed cannot allow the stock market to crash. By lowering interest rates as low as they have, pension funds, big institutions, insurance companies, you name it, they're all invested in stocks now. Okay, they used to invest in treasuries and high yield corporate bonds, real nice, safe. Well, they can't do that anymore at 1 or 2%, right? So they've all ventured out into all these other things. The Fed has to support that. You can't have every public and private pension fund collapsing. Well, the average pension fund in the first quarter was down 13%. Well, that dog won't hunt, man. They can't keep that up. Okay. Think all the 401k plans, people that are trying to save, the people with their IRAs. The Fed, if the stock market rolls back over, okay, 25,000 on the Dow or whatever. I'll just give you a number. Let's just say 20,000. Stock market rolls back over below 20,000. You know what's going to happen next? Fed's going to announce they're going to start buying ETFs. Just like the Bank of Japan does. That's what they will do. Anything they can to support it. So no one should think that the stock market is some kind of indication of how the general economy is doing. And to get back to the first part of this answer, I think it's tremendous because it shines the light, forces people to look at it and go, this is a scam, man.
Yeah. That's a great point you bring up, Craig. But let's not get it twisted. Let's not get it twisted, Craig. The Fed's not going to be buying SLV. They're not going to be buying GLD. They're not going to be buying GDX. Yeah. They're not going to be buying JNUG. That's for sure. We know what they're not going to be buying.
No, they'll buy the SPY and the triple Qs or whatever those things are. Yeah. But they will. I have no doubt. They're already buying corporate bond ETFs, right? The only thing they're not doing at this point is buying equity ETFs. And they will if they feel they have to. I have no doubt. No, I'm 100% certain of that.
Or not openly doing, as far as we know. But now, yeah. Craig, just so it's good to catch up with you every few months here. The last time we spoke was near the end of January. Things have changed. So just last question here, Craig. What is going to be on your radar now that we're moving into summer? What are some of the things that you're looking at in the markets? And what are some of the things that you're looking at in the economy as we move into summer here, Craig?
Well, I hope and pray, like everyone else, that we come up with therapeutics. We come to find out that the spread of this virus across not only the U.S. but the world is far greater than we know already, and vast. There's much more, many more people have had it than we think. We're that much closer to a herd immunity. I mean, we've never had a vaccine for a coronavirus at all. I mean, there's no cure for the common cold, right? And so I'm not overly optimistic we'll have anything for this. And so I'm rooting for that, just like anybody, with a heart would have that. We don't want gold and silver just going up because, millions of people are dying and out of work and all that kind of stuff. But that is what the world is now. So we have to deal with it. I'll be watching the two things I'll be watching most closely are the rate of interest rates. Because again, these expectations now that negative interest rates are coming even to the U.S. Heck, just as we record this morning, Paul, England sold its first bond issue at a negative interest rate. First time. Fed says they're not going to do it, but the market may force it on them because they're putting so much cash out there. So we're going to watch for negative nominal interest rates. But then we're also going to watch for negative real interest rates. I'm going to be watching for inflation really, really closely, because what I think we're heading into is maybe not a full decade of stagflation like the 70s, but maybe a period of 2 to 4 years of stagflation. And folks, have been around long enough will recall the 70s were a hugely wonderful period for the precious metals and the mining shares. And so that's the next thing I'll be looking for is inflation. Man, we get into a combination of negative nominal stated rates and negative real rates. Oh, man. Precious metals and mining shares are going to do some things that a lot of folks don't even think are possible.
Craig Hemke, I'd like to thank you for joining us today on Silver Doctors.
My pleasure, my friend. It's always fun.
Oh, Craig, I forgot to bring up that's when you brought up a great point about Powell, but that's one of the things I got out of this 60 Minutes interview was Powell did not say we're not going negative. He did not say that. He basically said we don't know if negative rates would work or not. So to me, and that's what I wrote about on Monday, was that they're like planting that seed saying, well, I mean, we got to make sure that negative rates don't work. So, I mean, how do we know that? We're studying it. So why not study it in a real sense? That's what I got most out of that too.
Yeah.
So it's interesting. I see what you're talking about. Everyone was talking about, well, we print it digitally. They were all focused on that, but there were other nuggets in there like, oh my goodness,
Yeah. So I couldn't be more. I mean, not on the day-to-day, God only knows. And we're doing everything they can for, maybe it's due to option expiration next week and the contract going off the board. But you can clearly see that 1750 and 18 have been barriers for the last couple of days. Yeah. They'll continue to fight us, like that. Boy, in the big picture, man, it's hard to see how. And maybe that's where I'm going to be dead wrong because I can't see it. But the way this is playing out, I sure think that over time, things are going to keep trending in our direction. So we should have a lot of fun.